We're back. No introduction. The stream died. We're going to pick up basically where we left off, albeit I did lose the comments, so feel free to inquire again what's on your mind. The whole system is changing, but that doesn't mean you're afraid. That doesn't mean you should be afraid. I'm not afraid. It means you need to know how to navigate. And it's pretty dark with what's going on with WorldCoin, and I'm not too fond of a lot of things of what the system is offering or the directionality that it looks like it's presenting from a structural standpoint, from a geopolitical standpoint. But there's nothing you could do about it except digest it and put on your sailor's cap and navigate it to the best of your abilities. I'm very fond of the place I put myself into this market in regard to I've minimized the choices and options that I can make and that I can take, which means I'm along for the ride, which means I will be here in 2025, 2027, 2030, 2035, 2040. There's nothing I could possibly do. And to me, that's everything. I've simplified the equation. I've ensured survival because I've aligned with things that are guaranteed to survive. That's the deal. I appreciate all of you jumping back on. 8 people, 2 likes already. Johannes in the house. We're back. Order the pine cones. Captain is back. Sir Joe in the house. Well, we were talking about aura. So there's 2 federations that are emergent, and obviously it's the balancer and curve federations. And they have third parties. They have, satellites, states, sovereign protocols, so to speak. And they do they're doing what I described yesterday on the Aladdin DAO Twitter Spaces, and that's very meaningful. With the geopolitical complexities going on, it's more important than ever to understand what the hell these countries did with regard to the post-$71, 1971 version of the dollar. And that's real what happened over the last 52 years. And that's a long time. So, it's like folks on social media, the dollar's going to fail and it's going to end and they can't pay this debt on the bond. Sure, okay. What if that process takes 100 years? It took Rome. It took the ancient great nation states 100 years of debasement. They were around for 250 years. So you can see how people get the time horizons or can get the time horizons very wrong. What happens if America takes the balance sheet to $500 billion over the next 50 years, next 75 years, and global currency supply is a quintillion, 1,000 quadrillion, and just everything just gets that much more perverted over the next 50 years, 75 years. So, the end of the dollar in 75 years. So it's so important to understand these time horizons, which is why I like looking at the 6-month and the yearly chart nowadays. And you can't dismiss the significance of the dollar in the grand scheme of things. It's not going anywhere. Because if it does, we're in a global world war. And then none of this matters. And none of this matters. Please, it's so important to digest. Have you looked into Velodrome? So Velodrome's cool. They're doing well. I'm not too fond of their top 2 vote renters. I'm not too fond of the protocols that are recycling votes. Evaluating that from a significance standpoint. And, they're right with regard to OP. Optimism and its capacity to just continuously finance from an OP perspective, the token asset. So the financing will be there, but who's accumulating velo from a protocol standpoint as compared to the balancer and curve federations. I'm not. It doesn't excite me too much from a structural robustness standpoint. The revenue's great, but you know you're either looking at an organization of countries in Central Africa, not to the discredit, or there's plenty of beautiful things about the countries, but I'm just making, you know, a robustness comparison from a financial system perspective. You're either looking at an organization of countries from there, an organization of countries from South America, or an organization of countries from Europe or Southeast Asia where there's a lot of financial activity. Where's the robust financial activity? And that's kind of like maybe a generalization of how I see optimism. I have a high opinion of the optimism network of networks. That's what I see playing out in many regards, like, atom and cosmos chains, cosmos hubs, networks of networks are quite meaningful. But there's such little liquidity. Yeah, let's go over liquidity. Let's see. Let's see where we're at. So you can be excited about all the shit you want on Arbitrum, Optimism, Polygon. How much liquidity is there? There's $617 million on Optimism. There's 1.35 billion on Polygon. So right off the bat, Polygon has that much more liquidity, which has the potential for that much more financial activity and capital flows and transactions that you could capitalize on with fees. Even Avalanche has significantly more capital as compared to Optimism. Arbitrum 1.76. At least Avalanche, Polygon, Arbitrum are over the bill mark, still all below 2 bill. And then obviously you go over to Ethereum with $67 billion. It's not even comparable. It's like talking about a small emerging market as compared to, a large major market. And obviously, even Ethereum is an emerging market relative to the global financial system. It's a relatively microscopic number, $67 billion of liquidity capture. So these small markets are basically insignificant in size. Where does the capital flow? Why would it flow to the L2s as compared to mainnet? There's the retail versus like the large actor narrative. Like obviously retail, the small actors, $1,000, $5,000 portfolios, they're all going to the chains where there's basically zero transaction fees. Phantom, for that matter. Obviously, there's a lot of complexities over there, but it's a very functional chain. But my argument is the large actors will go to mainnet because that's the network, and that's where the guaranteed finality is. So if you're going to be running around with billion-dollar transactions, it's going to be on mainnet. It's not going to be on the L2s. They don't want that increased risk exposure. They don't need that kind of exposure. Anything that's on the L2s is either already on mainnet or is trying to deploy to mainnet. I mean, even look, Trader Joe wants to deploy on mainnet from the last couple of social media posts that I've seen. And there's a reason. It's because that's where the liquidity is. So while I have a modestly high opinion of Velodrome, I'm not fond of the liquidity situation on Optimism at all. That doesn't discount the possibility of opportunity. Look, I have a fair amount of exposure to Solana vis-a-vis Hero Network, and I was in YOLO. YOLO went to mainnet as NOLO. And NOLO, where do you think it's going to transact? That thing's going to be using Hero Network on Solana. So there's a lot of speculative things that are going to play out over the next 5 years. Like you have your assets on mainnet, but you're executing not on mainnet, and that's actually quite an interesting thing that is obviously going to occur with technologies like what Chainlink offers and what Layer Zero offers, where you have a capacity to do a transaction on one network and execute it on another network vis-a-vis trustless messaging implementations, and that's very powerful. It's kind of like the way sovereigns work, where work is exported to another country, or mining is exported to another country and is imported back to mainland. And this doesn't have to be from a U.S. centric perspective, but one country does work and it's benefiting another country. And in this regard, those sovereign countries are these networks. Ethereum mainnet is outsourcing work to Solana in this instance with regard to Nolo and the hero relationship. And that's quite interesting. This is all going to play out in that kind of that kind of perspective, that kind of consideration that you can have, comparing to the way sovereign countries relate to one another. It's because these systems are global scale and scope. They have characteristics of nation states from a financial activity perspective. Let's keep it going. Sir Joe's back. Killis, have you hit the velodrome question? Shishk, how much is changing quickly? It's getting hard to keep up. Well, there's the quickly changing stuff, which is obviously on that's daily. It's you could follow the charts and you're literally seeing it. The dollar was below a critical mark. Now it's pushing back above. Wow. Let's go to the weekly because that's what I was monitoring. I want to see it hit the 100 SMA and get rejected. So there's 6 hours left for the weekly for it to hold the 100 SMA as resistance, but that's a double bottom, a tweezer bottom on the 200 EMA of the weekly. You zoom out to the monthly, you could start seeing the picture. These two circles are what everyone knows as the crypto bull markets. That's what took Bitcoin from $250 to a couple $1,000, and then what took it from a couple of $1,000 to $60,000. That's these two circles. That's it. And that's because I feel that international liquidity conditions are much more potent than domestic liquidity conditions. And I think this chart expresses that in a very meaningful way. Mike Howell from Cross Border Capital has a much better understanding of liquidity than I do. I appreciate how he inverts it. Liquidity is really the capacity for a system to absorb risk or process risk, which is basically the opposite way of saying that capital credit can be issued and risk can be taken. How much risk capacity does a system have at any given time? But as the value of the dollar comes down and foreign fiat becomes, more powerful from a purchasing power perspective, you could take on more risk because you have relatively more purchasing power. You could buy more, therefore you could buy more collateral, and therefore you could acquire access to more credit, dollar denominated, which is what the world loves to do, and dig its own grave, but that's another story. So to me, this chart is a generalization. Obviously, it's predominantly Japan and Europe, the euro and the yen. China is a big component to the global liquidity picture, but this is a great way to get a general sense of where a good part, if not the vast majority, of currencies relate to the dollar, because you could obviously pair every other foreign fiat with yen and euro. So they're the most powerful currencies aside from the yuan, which has another complicated story. Their onshore versus offshore yuan and their capital control, so on and so forth. So really, my general sense is this chart tells a great story of international liquidity conditions without having to dig into every single FX pair and try and deduce the overall picture more granularly. Isn't that remarkable? Everyone in crypto, this was their bull markets, and it's just two tiny little circles. And that's why if you see the breach um, through these long-term moving averages to the downside, it tells you have significantly increasing liquidity conditions, and that obviously affects the behavior of market actors. Obviously there's other interesting stories on a daily basis, which is what Shishk is talking about. Like we're in uncharted territory with regard to the bond market. We're in uncharted territory with the domestic credit conditions. If obviously, 2,000 regional banks have impaired balance sheets where their HTM portfolio is just they can't sell anything. It just be they'll be done because they don't have the capital. Everything depreciated on their balance sheet so significantly. They have just an impaired balance sheet. So what kind of credit can the system extend? And this whole system is dependent on extending credit to roll over debt. And how could he roll over debt at these interest rates? So you see all these potentialities for like extraordinary deflationary pressures in the short term. Um, but that's not going to work from a global fiat collusion standpoint. They want the system to continue. They don't want the deflation to occur. So at some point, you're going to see those relationships between geopolitical powers come into play, and you'll start to see movement, directionality in these charts that indicate stabilization. Why? Because cycles will cycle, and they will achieve what they're supposed to achieve, which is stability and continuity, and to preserve, existentiality. Everyone wants the game to continue. It doesn't have to be black and white. Like the game is going to continue. The game is going to end. They're going to do what they can to hit that gray area. Like, yeah, it's going to continue. And it's that gray area that scares the shit out of everybody, especially, the smaller portfolios and people just starting to get into investing because they don't know whether something is going to go significantly higher in price point or it's going to go to zero. It's going to be completely fail. It's either going to continue or end. It's not black and white. There's a lot of gray area. But that's what we've done on this stream over the last years is identify a means of navigating that gray area and seeing what has a greater than less likelihood of surviving. And anything that survives and is able to navigate those future cycles is going to do very well for us, for me, for you, as components of a portfolio. They'll be very meaningful. All you have to do is survive. Keeping it simple is easier said than done. Yes, which is the story that I try and tell. If international liquidity conditions increase, you're going to see capital flows from underperformance to outperformance. You're going to see capital flows from more friction to less friction. If credit freezes up, you're going to see, for reasons of existential crisis, you're going to see actors do what they have to do to survive. And if they can't find credit with banks, they're going to find credit in shadow banks. They're going to find credit wherever the hell they can. Why the hell do you think mobsters love loan sharking or whatever? Whoever does the loan sharking nowadays. Because people seek credit when they get desperate. You think that's just personal and stories of old? No, that's businesses and countries alike. They're going to find credit wherever they have to in order to survive. And it just so happens that the crypto space has credit markets that have zero friction. So over the next couple of years, this could be quite interesting. Or the Pineco is very impressed with how you've built your Curve position. Curve is the safest when it comes to liquidity volume with the Ethereum network. But what's your opinion on Velodrome? I'm pretty sure I started talking about that on the earlier stream that failed. I talked about liquidity so far. Now I'm not fond of the liquidity conditions on optimism. I don't see the opportunity Or I don't see the indication that is catching my fancy of consumer sterilizers. What protocols, what large protocols are locking fellow? That's what you want to see. You need to see that. With any currency producer, you need to see actors that are actively removing that excess supply from circulation. That's it. So in that regard, I'm hopeful for Bunny to acquire more sterilizers. I've seen Liquis come online, or soon to come online, whichever one it may be. And that is by definition a sterilizer. And what do I mean by sterilizer? Basically LSDs, liquid staking derivatives. What Stake Dow does, what the Aladdin and the concentrator do, and there's a lot. There's a laundry list. I don't even know them off the top of my head. We talk about them in the Federators channel on our forum. Or I'd love to talk about them more, but those are the protocols that are actively removing excess supply from circulation. Now, I don't see that with Velodrome. I don't see that on any other network other than mainnet. But then again, what do you see that with? Balancer and Curve Federations, and Aura happens to be spreading to the other networks. So how does that play out? Balancer is on those other networks, and Balancer is had a friendly fork with Beethoven, and Aura will drop the incentives, and Beethoven will have the incentives. And when you have 50, 75, 100% APRs on LPs, the capital flows in, and it comes from other places that are underperforming relative to what the incentives are causing to outperform. And that creates the capital flow. And this is going to play out over the next 6 months or into a year probably. And capital will flow based on Balancer and Aura's capacity to incentivize LPs and drive capital to flow into them. So from an optimism, an Arbitrum, from a Polygon perspective, what am I most interested in? Probably the Balancer Federation. They extended there, and they're going to have a capacity to finance significant capital flows. Raul's in the house. Yam, good morning. Do you have any time frame estimates to say a 10x increase in VE curve protocol fees? How do you think about that? I don't have a time frame preference. As of right now, my mindset is entirely on survival. Folks are like, there's no bull market. What you're seeing is a negative sum game, which is causing concentration of capital. You're seeing a test of survival. You're seeing, even in 29 when you had the depression, there's still plenty of businesses that did very well. You still had businesses coming online. You still had businesses starting up and getting capital from banks. There was crisis everywhere, but that doesn't mean there's still not opportunity to capture capital flows with new businesses. Look what's going on with YOLO and NOLO and Unibot. That's very interesting. But there's significantly a depressed state of economic activity. So that's what we're in. This is a deflation. There's a deflation of currency in the United States since end of 2021. And globally is another story because of what Japan and China are doing from a loose financial conditions perspective. And it happens to be the case that the crypto markets are not a U.S. market, and it's a global market. So that's why we see this interesting price action going on in the crypto markets from a global perspective. There's plenty of catalysts for significant deflationary pressures yet to come that still haven't presented themselves. My base case, if you want to have like a 6 months to a year perspective, I'm highly expecting a significant volatility event, which will create forced selling. And how much forced selling, I don't know. 2022 hit the crypto space pretty hard as compared to U.S. equities. Can we have more forced selling in U.S. equities as compared to the crypto market? Oh, yeah. There's trillions of dollars to be sold in U.S. equities. There's not trillions of dollars to be sold in crypto markets. There's $67 billion available of currency units. If it's here and it made it through 2022, because that was just a completely negative sum game throughout the entirety of 2022 in crypto markets, why the fuck is it going to leave at this point? From a global perspective, because obviously U.S. equities is, most part a U.S. A forced selling consideration for U.S. Uh, uh, you know, acquisition of liquidity. You sell to acquire liquidity. So there's a great likelihood that crypto markets outperform relative to U.S. equity markets in a deflationary event. And outperform doesn't mean not going down. It means going down to a lesser degree. Overall, my general expectation is a higher low. And folks, let's put log because it looks better. So this is the monthly on the total capital, or total capitalization of crypto markets, excluding Bitcoin and Ethereum. So maybe a higher low. Maybe this is a double bottom, January of 23, and we sure as hell bottomed in July, which is this month, last month, June of 23. Last month we bottomed with a giant wick. So maybe that was our double bottom. Maybe we have a higher low. I don't think we're going below $291 billion of capitalization, excluding Bitcoin and Ethereum. And this isn't stable coins. I wish we had more data on stablecoins. Maybe I could pull up a total market cap of stablecoins in TradingView. That would be a nice chart. Just add them together. Higher low, and at some point they'll have to lose. So we have the loosest financial conditions with increasing rates in history in the United States. But at some point, all this debt needs to roll over, and they can't roll it over at increasing rates. They can't roll over the majority of U.S. debt at 4%. That just doesn't make any sense. That's just not possible. So between now and 2025, some interesting shit's going to go down. And it'll be unique. It'll be historic. And I'm going to be front row seats to see what the hell plays out. Let's keep it going. Do you have any framework in mind how to estimate increased bribe revenue? Yeah, liquidity. As liquidity increases, capital flows to persons that have access to them are going to increase. So generally speaking, just follow this one graph. This is probably the simplest way to see the liquidity, what changes, deltas in liquidity on particular networks. So when you see this go to $670 billion, come on, you know how much financial activity there's going to be? You know how many startup protocols there are going to be that need to finance liquidity depth? That's when you see your revenue start to increase. When capital flows into crypto markets out of 195 countries around the world. Generally speaking, I expect to see more favorable market conditions probably prior to 2025. You need to get into 2024. There's too much shit going on right now. Nothing's going to happen in 2023. We get the halving probably first. That was mid 2024, whenever it is, which is not. I don't want to digress into my opinions on the halving, but generally speaking, it's fascinating how well the halving lines up with what Raoul Pal noticed, that every 3 to 5 years, the difference between delta GDP and sovereign financing obligations ends up on the balance sheet. So liquidity conditions are quite likely to improve heading into the end of 2025 because someone has to finance shortfalls in debt servicing capital that's available. And that turns out it's mostly central banks that do that. A global collusion. So we'll see a liquidity cycle. It's inevitable that the liquidity will cycle again. And what market do I want to be in when the liquidity flows start happening? I want to be in a market that's not any market, that's outside of any market, that's accessible to any market. And when I say market, I mean markets of 195 sovereign countries around the planet that don't need an intermediary to access. If you're in Singapore and you want to access the New York Stock Exchange, you can imagine what you need, from KYC and to onshore bank accounts and maybe an onshore entity, a corporation as a counterparty to engage in that kind of transaction activity. You don't need any of that with crypto markets. You're going straight from Singapore to the crypto markets. That's fascinating. That's, to me, the biggest opportunity there is out of anything that I look at in traditional finance from an opportunity perspective. And I see opportunities in traditional finance that I talk about every now and then, from an energy perspective, a mining perspective, from a battery metals perspective. That's cool, but I don't see that as like exciting opportunity. I see that as just opportunity. I see the biggest opportunity in these markets because these are purely financial markets dealing with credit and FX. Not even the derivatives and gambling. Credit and FX. That's the products of the crypto markets. And that is the biggest products on the planet. Trillions and trillions of dollars go through FX. Arguably, upwards of $250 billion go through credit, the Eurodollar market, and the expansion of liability, so on and so forth. And that's this market. That's the crypto market. Tony, thoughts on Bitcoin volcano bonds from El Salvador as an investment? Not for myself and not for small actors. Who would want to expose to that? It's probably nation states, peers and other parties down in South America and Central America. They probably have interest in that. That's not of interest to me. All I want to do is take capital and lend it to people and charge them interest. Banks do that. I want to do that. And the difference is, in crypto markets, these protocols have emerged that allow us to do that, indirectly, and we own the cash flow associated with that liability creation, that credit extension, and the swapping of assets in an FX type of system, foreign exchange. And that's what we have exposure to. When you think, you guys are talking about Velodrome and Curve and Balancer and exchanges, what do you think that cash comes from? Where that cash flow comes from? It comes from FX. That is an FX system, foreign exchange. You're exchanging one asset for another, or one currency denomination for another. And as more countries come online with stable coins, CBDCs and stuff like that, they're going to want seamless cross-chain, and that's the whole Chainlink narrative. And how are you going to exchange it in these markets using these systems that we're talking about? People will want to use these systems because this is the public infrastructure. A narrative that I talked about with regard to like Digibyte a long time ago. Public infrastructure is meaningful because it's not of a nation state, it's of all nation states. It's infrastructure that's not owned by anyone but owned by everyone. Anyway, do you think we're out of the woods with all this talk of recession? No, the recession is very much coming. We're in a deflationary implosion. Are there more domino pieces to fall with regard to equity crypto prices? So that's kind of what I talked about a little earlier about which outperforms. We're on course for a deflationary crash, a deflationary implosion. Everything in nature operates in directionality and cycles. There's no such thing as steady state. You're either expanding currency supply or decreasing currency supply. You're either gaining weight or losing weight, and everything is binary in nature, left, right, up, down, team A, team B. And that's the way everything that we've created manifests. All the derivative shit that humans create manifests in that binary kind of way. So we're clearly not inflating. We don't have increasing liquidity conditions. We have contraction. So a contraction with this kind of debt load at a global level is heading towards deflationary implosion, where you're not able to service the debt, or you're not able to refinance the debt to kick the can down the road. So the question becomes, what does the Fed want to do? The Fed is gonna have to. They're playing the resonance game, and they think they're going to be able to time the bottom. They think they're going to be able to lower rates to extend credit, so credit starts to flow from commercial banks before credit completely freezes and we have some sort of credit event. They think they're going to be able to adjust accordingly. And, I'm not too fond of thinking that they can do it. So I think we end up maybe in some sort of emergency financing situation yet again, which is just 3 and 4 letter acronyms from the Fed, which is basically going to increase liquidity conditions. And when you increase liquidity conditions, there go the markets. So what we have is still a slew of deflationary pressures spread across the system, with highlights of reactionary measures to those deflationary pressures that will cause, relative inflation in currency supply, or increases in liquidity conditions, which will cause price appreciation. The pressures are all over the place. So, which means remain exposed to the markets, and what's the time frame for the exposure to the markets to bear fruit? I'd say about 2025. That's my general sentiment from a time frame perspective. Hope that helps. Do you think Coinbase will have any positive effect on Optimism's liquidity? Speculative. There's two types of cash flow. There's what is right now and it growing into the future, and what isn't right now but is speculated to be there in the future. It's like probably the best protocol I could say that rings home for me that case is Frax. It's not very cash flow friendly from the gauge perspective, the vote rental perspective, but just the scale and scope of what's possible is quite speculatively amazing. That's got to be the best example of that, in my opinion. I don't know. There's plenty of opportunity to be had on base. There's plenty of opportunity to be had on optimism. I just don't see it right now. Things are not checking my boxes. But as I say, and we say on Discord often, it doesn't have to check my boxes. There's plenty of opportunities that I will miss and that other folks will find. The hook, wondering your thoughts on Aura, expanding the multiple chains. I'm pretty sure I talked about it in this stream, either that or I started talking about it on the other stream. So Balancer, the Balancer Federation is a big deal. It has carved out its niche. It has survivability written all over it. I have exposure to Aura and Balancer for that matter with regard to VE-BAL and VL Aura. It's I would consider that part of my core portfolio. I'm just going to continue to enjoy the cash flow from it. My expectation is that cash flow would probably continue to go down a little bit, or a lot of it. But I expect it to survive into increasingly favorable liquidity conditions, in which case that cash flow will increase. So cycles will cycle. The difference is, are folks focusing on the cyclicality of price or the cyclicality of cash flow? With regard to price, cyclicality means you want the cheapest price possible for something that is likely to survive. So something that produces cash flow, you want to buy it as cheap as possible that has survivability written all over it. Because if you bought it as cheap as possible and it produces cash flow, when there's favorable liquidity conditions, that cash flow is going to increase. That's generally my equation. Would you mind going over again why position size is important when choosing a yield protocol? If you're not going to get the cash flow that you want or need, you may be over diversified. The smaller a portfolio, the more concentrated a portfolio needs to be. The smaller a portfolio, the greater the risk that needs to be taken to achieve expectations. And too often expectations are irrational, and we must remain rational. So for instance, a larger portfolio, a $5 million portfolio, it could depreciate 80% and still be $1 million portfolio. And if the portfolio is producing 20, 30, 40% APR, that's still a shitload of cash flow. So there's a lot much more wiggle room with a larger portfolio with regard to cash flow and it being effective or meaningful or useful amounts of cash flow. Smaller portfolio has different considerations. A $10,000 portfolio getting 20 plus percent APR, $2,000 a year. You're not living off $2,000 a year, but maybe your expectation is you want to finance a car, or lease a car for $150 a month. Now your $10,000 portfolio is effectively paying your car finance or lease. And then maybe that $10,000 portfolio becomes a $100,000 portfolio producing $20,000 a year in the next 5 years. That's pretty cool. That would be an interesting sequence of events to play out for a relatively small portfolio. Now, bear in mind that $10,000 portfolio is not becoming a $10 million portfolio necessarily. So expectations are an incredibly complicated thing to get a grasp of or control over, not setting expectations too high. I expect less outperformance for these federated protocols as compared to, different types of assets or different types of, enterprise protocols. I don't expect the asymmetric 100,000% appreciation, like what you have with the meme coins and some people getting lucky turning $100 into like $5 million. I don't expect that kind of behavior. I expect more of a value type of investment in traditional financial terms. But the value types of investments in the crypto space, if you approach inspecting the subtleties, the relative balance sheet of these protocols, still expect significant appreciation. Why can't you get a 10x on these federations in the next by 2030? But that might not be what someone's expectations are. You might not want a 10x. If you have $1,000 extra and you gratefully or hard work, you've been able to save $1,000 and you want to invest, 10x doesn't do much. It's not life-changing at all, and it's not even very useful from a cash flow productivity standpoint. So that's why there's such a smaller portfolio. Considering expectations, you might need appropriate position size, very concentrated, and take on extreme risk to turn $1,000 hopefully into $100,000, hopefully in a relatively short period of time. And that's what Charlie Munger says. Charlie Munger always said, you do what you can to get to 100 grand, because it's very hard to get somewhere on $1,000. But with 100 grand, it's much easier to turn 100 grand into $1 million as compared to $1,000 into $1 million. The equation changes. It gets much easier to make capital with larger sums of capital. Position size and expectations are very hard, as well as in consideration of portfolio size. Paul, have you heard of software paper that recently that offer had the talk take down? Yeah, that was interesting. Even BlackRock put out some information about Bitcoin. We'll see what plays out. Do you really think you're going to get 1,000%, 10x on Bitcoin? I think the case is diminishing returns in many regards. It's irrelevant. I'm not. I don't. So that's why. How did I simplify that equation? There's a lot of folks their expectation for a Bitcoin allocation is like the world ends and Bitcoin is the only money that's left that has any value. And what did I do to simplify the equation? All right, whatever happens, happens. That doesn't mean anything from an opportunity standpoint. I want to outperform what Bitcoin does. I want to outperform what Bitcoin offers. It offers no cash flow. So what do? I consider Bitcoin the cash position. It doesn't that really turn things upside down? I don't even consider Bitcoin an investment nowadays. I literally have a cash position. I have cash, as in dollar liabilities in a bank account. I have cash, paper dollars. I have exposure to stable coins, dollar liabilities in cryptocurrency form. I have Ethereum that I consider cash. I have Bitcoin that I consider cash. I consider this cash. I have savings of cash, and if I have to spend it, I spend it. If I need a roof, I'm going to buy a roof, and I'm going to spend the cash. I don't consider them investments. Now, it gets complicated because you probably don't want to spend Bitcoin when it's the cheapest. You probably want to spend Bitcoin when it's more valuable, and when you want to spend it as a form of cash. So you might be less inclined to use part of your cash position if you think Bitcoin is going to appreciate, which I do by 2025, give or take. So different components of the portfolio serve different purposes, have different time horizons, and the whole thing I encourage is defining these things. Now, you could use my definitions of things, and this is how I define them for myself, and other folks define things very differently. Some folks define Bitcoin as an investment or Ethereum as an investment. I don't anymore. I consider them cash. Hope that helps. Take what you hear from me and what you hear from other economists and other financial advisors and build your own framework that expresses your expectations. And just remember, you just need to survive. That's it. Survival is everything. I mean, it's what Warren Buffett always talked about. Just buy low cost index funds. And if you do that for 20, 30 years, that's what he always talks about, because it survives. Because that's the whole point of government. The whole point of government is to keep the machine working. It will survive. But I don't see much opportunity in his older mentality, his older methodology from a traditional equities market perspective. But I do see the usefulness in the story that he tells of how to manage capital and the time frames involved. But I see it having much more opportunity from the crypto market perspective. Hope that helps. Curious, also, you using any AI tools for your mobile app, React Native? I use ChatGPT a lot, but it's not the end-all be-all of correct. I don't do React Native. I'm not fond of React Native. I'm much more fond of Flutter. Never been fond of React Native. I'm not fond of just the language. I like Dart much better from a Flutter perspective. Much more intuitive software language as compared to Kotlin. So I feel at home. I feel just comfortable with the language. Anyway, point being, ChatGPT is extraordinary. Hope that helps. What should I do in regards to X? There's probably nothing to do with any immediate action. I don't think there's. I have taken very few financial actions in 2023. In fact, I took less financial actions in 2022 as compared to 2021, and much less financial actions as compared to 2020. So as I've gotten more mature with these markets, I've actually done significantly less. And I need a shitload of confidence and confluence to really do anything nowadays. And, what have I always said? I've always said 1% to 10% changes everything. And if you are very picky with deploying capital, you'll find those 1% positions. So most recently, I had a bunch of YOLO on Solana, and that came over to mainnet, and that's done very well. So this was very much this wasn't even a 1% position, but interestingly enough, all of a sudden it's become a 1% position, 2% position. So this thing went from 0.1% of the portfolio to 1 or 2% of the portfolio, which is quite satisfying to see. And those are the types of risks that I take nowadays. I take very small risks. For me, maybe a couple thousand, $1,000, $2,000, $3,000, $4,000, $5,000, and it's not. This is literally the only thing I think I bought in 2023. Well, I did. Did I take the Hero position in 2023? Hero went down. It's up. I see Hero as a federation at this point. They have so many protocols that are going to consume it as a source of liquidity. It's quite interesting, and I'm not dissuaded at all of the from the Solana narrative, considering what Hero has built. I find it quite appealing from a protocol perspective with the products and services that they're offering. So the question there is, can you get it cheaper? Can you want to buy something that you think is meaningful at the cheapest price possible? And that's easier said than done, obviously. And this looks like a giant rising wedge. Come on, this is a brand new asset. You could easily see this thing breaking to the downside and pulling like brush. Break to the downside, bump up, and it just runs all the way down, just like every damn asset does. And then it goes sideways freaking forever. And then liquidity comes back in sometime. Look, this is 2023. This is the 4 hour chart. And it goes sideways forever. And you just keep going. And then in 2025, it goes to $50. So in that regard, LP positions, undo, undo, undo. Oh, I made a mess of this chart. LPs are interesting. So that's my exposure to this asset. I expect this thing to just maybe continue to go up, but at some point people are going to be taking profits, and it's going to go all the way down. So, that's the risk everyone takes. Wait for it to go down. There's no. What are you going to buy something that was 50 cents when it ported over to mainnet at 260? No, I would never buy something like this. There was nothing on Solana. If you looked at the Solana chart, it was straight down. But it comes over to mainnet where there's liquidity and relatively illiquid LP availability, and it's appreciative. So this is going to be an interesting one. I expect this to actually be a component of the portfolio for a long time as LP form. It'll just churn. It's going to go down, it's going to go up, it's going to churn all over the place, and all the while producing cash flow because of people using the protocol. So this is actually a cash flow protocol like Unibot. Unibot produces a fair amount of cash flow. So this is an interesting emergence in mid 2023. Unibot and Nolo and the perps and the bots. Interesting stuff. Um, hit the likes, everyone. I appreciate it. 15 likes. We did great today. Captain, your take is always appreciated. I appreciate you guys too. Aloha Fridays. Big Cap, hope all is well. Big Dog, Ryan Anton. Always a pleasure. If there's anything else I could go over, throw a couple of last minute comments if you want. We could. I'm not too fond of the way the weekend is shaping up. The dollar is in a precarious situation. Holding bottom for all of 2023. It bottomed over here in February, it bottomed over here in April, and it looks like it's not able to breach that bottom again. So that would be consistent with a triple bottom. This is a hell of a wall. Albeit, if you invert it, that's like a ceiling. And if you keep hammering a wall, it breaks. So this may be the case where this breaks, and that would be nice. And that's what I see, especially from a 6 month perspective. I see this just a tremendous shooting star. It's actually bigger than the 1985 yearly shooting star up here. And that's indicative of trend reversal. Look, this is one candle past 2022. From the yearly chart, it's even more more expressive of what I try and tell about the 6 month chart. Check back in this chart is like check back in 2030. If it breaks below the yearly TWAP and a break below the yearly TWAP, you're going to have ridiculous price action in risk assets because there'll be a significant increase in international liquidity conditions. But this is going to take another couple of years to make a move over there. Look at that, 2008 to 2022. This thing could cycle for 10, 15 years to the downside till it gets down to maybe 60, or it doesn't produce a lower low. But historically, it always did. Why? Because the U.S. has to finance international dollar demand. Otherwise, the game doesn't work. This could easily be a 15-year cycle of dollar depreciation. It could be quite interesting. Will you sell BTC if it hits a new high? I will adjust my cash position. It's not if it hits a new high. Hello. Okay. Let Daddy finish his stream, honey bunny. Grab your phone. Hey, Big Bear. I will adjust my cash position to have more dollar liabilities, stable coins. I will adjust. That's the bottom line. It's not buy or sell. It's composition. You want to have all these assets. You want to own Bitcoin. You want to own Ethereum. You want to own stable coins. It's what is the proportion of them, the balance of them that matters. So yes, of course, no anyone in their right mind, you see Bitcoin at 60, 70, 80, 100, you should be selling some of it, 5%, 10%, 15%. You don't sell all of it. You want Bitcoin. There's the whole in it for the tech narrative, and I'm cool with that. But I'm going to have to adjust the cash position of the portfolio accordingly. That's the thing you do. You sell on the way up, and you don't buy on the way down. But well, you do. But that's the hardest part of this activity is when do you buy? You want to buy as cheap as possible. And when things are going up in price, that's when you're selling to people that are late buyers, unfortunately. All right, we'll wrap it up for today. I appreciate everyone joining me on this Friday and remaining in this market. That's probably the best thing I could continue to advise everyone. What you do is you manage a portfolio and you survive and you structure accordingly and you manage risk. And don't take on risk in this market unnecessarily. You need to have a high degree of confidence to take on any risk, and the risk you're taking is 1% of the portfolio, less. And if it does, exponentially well, asymmetrically well, that's great. If you're able to capitalize in this kind of liquidity condition, then you have a capacity to survive. You've attained the skill set that's required to survive a market. How many people wished that they were in the market in 2020 and they weren't prepared in 2019 and they were like, holy shit, look at the volatility, Bitcoin's crashing to 3,000 in March of 2020. That's not something to fear, that's something to understand, and that's something to navigate. You want to be in the market when it bottoms. The only way to buy Pico bottom is to have assets at Pico bottom and to ride the waves and put on your sailor's cap and navigate. Quantified, I appreciate you as well. Thank you all for joining. Tell everyone to subscribe. I'll be on Discord as always as our lovely community dwindles, but there's still folks that have been successful. And I encourage everyone to try to remain exposed to the market and navigate accordingly. Listen, if you're sitting in all unstables because you're afraid of everything, I mean, at least you're still in the market and you have a greater capacity to acquire assets at depreciated prices than someone that's in dollars that has to now figure out how to get capital into the crypto space. So you're still in a better place as compared to the vast majority of people that have their money in a bank account. They have to ACH to Coinbase and learn all about, hardware wallets. And so I guess all in all, find your comfortability and survive. See you guys on Monday. Enjoy your weekend. You know the deal. Peace.